All right, so here we go with chapter 6, and there are going to be a series of these videos. So be sure to check them all out. Remember that there are also chapter 6 notes posted in the files section on our Canvas site. All right, so here are the big ticket items from chapter 6. Okay, so these are the things that we are going to focus on. So ASC 740, all right, the income tax provision process, determining when a valuation allowance is needed, and then accounting for uncertain tax provisions. All right, so we will discuss all of those items and have some problems related to them as well. So first off, let's talk about ASC 740. Okay, so ASC 740 deals with income taxes. All right, it is very important to know that it deals with income taxes, not sales tax, not payroll tax, income taxes. The rules are not IRS rules, okay, because this is not related to items on your tax returns, so to speak. These are items related in your financial items located, in your financial statement. The objective of ASC 740 is to compute the current income tax liability or benefit and to recognize deferred tax liabilities and assets. Okay, and we will talk about both of those things. It is important to remember that this is a balance sheet focus. All right, so ASC 740 focuses on assets and liabilities, okay? And then there are two primary objectives, and I'm going to move things around, all right? Our two primary objectives is to recognize the amount of taxes payable or refundable in the current year, okay? And that is going to give us our current tax liability or asset. And then we also have to recognize deferred tax liabilities and assets for future tax consequences, okay? And so both of these objectives relate to reporting a company's income tax amounts on their balance sheet, okay? Again, on the balance sheet, not on the income statement. There should be a T there. Apologize for that, okay? All right, so what are deferred tax assets? How do deferred tax assets arise? Okay. So the first thing we need to remember is that deferred tax assets are a result of temporary differences. Okay, not permanent differences, but temporary differences. And why do we end up with this deferred tax asset? Well, we end up with that deferred tax asset because initially taxable income as a result of these temporary differences is larger than book income. So what does that generate? That generates a future deductible amount because deductions would be low here. And so then as those amounts reverse, we're going to generate future deductible amounts, and that is going to create a deferred tax asset. As you might imagine, a deferred tax liability, this should be deferred tax liability, is also a result of a temporary difference, okay? It just reverses the other way, right? In this situation, we have book income is larger than taxable income. So what does that mean? That means that we're generating future taxable amounts, because if book income starts out larger than taxable income, we deducted things early on, and now we're going to generate future taxable amounts as those amounts reverse, and that is going to end up with a deferred tax liability, meaning down here, later down the road, we are going to have more tax liability. All right, so let's look at a potential question now. So I'm going to make this a little bigger. All right, so which of the following statements is true? So let's read all of these. Another name for a taxable temporary difference is an unfavorable difference. Another name for a taxable temporary difference is a favorable difference. Another name for a deductible temporary difference is a favorable difference. And another name for a deductible temporary difference is a permanent difference. Okay? So let's think about what a favorable temporary difference does. All right. A favorable temporary difference causes your current year taxable income to be less, right? So that causes your current taxable income to be less than your book income, which means this is this year, year one, and then potentially in year two or some year down the road, so year X, that is going to reverse a reversal happens, and what does that do? That causes a taxable event, okay? So then another name, I'm going to move this up a little bit. Another name for a taxable temporary difference is a favorable difference, because it's going to create a taxable event in the future, but it is a favorable difference right now. So the correct answer to this would be B. And that is where we're going to end this video. I'm going to try to keep these short so that they're more digestible.